Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of February. Now, I can tell you that the month of January for the S&P 500 was not hot. In fact, the S&P 500 was on track for one of the worst performances in January ever up until the last 2 trading days of the month, where we saw a little bit of a rally take place. On net, though, the S&P 500 was still down 5.3% for the month of January. If we take a look at the price action that took place in January, here you can see the S&P 500 really at the beginning of the month just started to head lower. It's all of a sudden investors started to say, hey, we want to be a little more cautious here. And we saw the stock market head lower. It came all the way back to the end of September low around 4,300 here. And it bounced off at this level. That was a fairly significant level of support for the S&P 500, and investors pushed that up, the S&P 500, towards the end of the month. On a relative strength index basis, did become oversold. A lot of traders do follow this, and when that index becomes oversold and turns higher, that's sometimes a signal to actually step back into the market as well, so it helped to squeeze the market higher overall. Now, if we take a look at what's more important right now, looking forward, is the month of February. So where do we stand in the markets? What should we expect coming up on a seasonal basis? I'm going to take a look at some of the different sectors as well in the marketplace and take a look at where we stand right now with those sectors, and also take a look at their seasonal trends. So let's jump right in and take a look at the Thackeray's 2022 Investors Guide. Okay, that just came out in December, or late November, I should say. And here you can see that for February, I can find it here. For the month of February, on average, the S&P 500 tends to be one of the weaker months of the year. Now, we're still in that strong 6-month favorable seasonal period for the stock market, which lasts towards late October into early May. And so far, that's actually working out very well. We've seen a strong rally that took place in October, November, and into December. But February tends to be overall, on average or long term, tends to be one of the weaker months, particularly in the last half of the month. This graphs from 1990 and 1950, I should say, to 2021. Every February is different, of course, but this is where we tend to have a little bit of weakness. It's really in the second half of the month, and that's what we need to watch out for. And that's particularly the case this time around. I'm going to talk a little bit about that regarding the Federal Reserve later on. But I do want to point out that over the last 10 years, though, February has been a counter trend, and what it's done is that it's actually been positive 8 out of 10 times. And very often what you see, if you see a big pullback in January, the S&P 500 can actually bounce in the month of February. So we're set up for that right now, and it would be good to see that actually take place. But just as an overall backdrop, February tends to be one of the weaker months of the year. I want to take a look at the different sectors of the stock market in the month of February. Here you can see from 1990 to 2020, and these are ranked according to their average gain in that time period. The second column, or this last column I should say, represents the frequency of outperformance relative to the S&P 500, and this is also an important number as well. So the materials sector is actually one of the better sectors here, with an average gain of 1.2%, and I'll take a look at the materials sector in a second. The energy sector tends to do well. Now, I do want to point out that on a frequency basis, it tends to be weaker. It's less than 50% outperforming the S&P 500. Now, the energy sector does start at a strong seasonal period, on average, later in the month of February. Now, the sector's done extremely well in the month of January. January can be very volatile, and sometimes it's a good time to pick up the energy sector. But this time around, the energy sector basically went straight up. And that can happen with commodities and the commodity sectors overall. The large outside influences can really sway against the seasonals or really enforce them as well. So you tend to find a lot of volatility with those sectors. Consumer discretionary sector tends to be one of the better performing sectors as well. Industrials tends to do well. I want to go down to utilities here, way down the list here. It only outperforms the S&P 500 28% of the time. Now, the utility sector has actually been doing okay in December and January, and that's because investors are still cautious in the market, and they've rotated to some of the the defensive sectors, and the utility sector has been a beneficiary of that. Let's take a look at a couple of these sectors here. I'm going to jump back over here, and let's take a look at the material sector here. Now, the material sector in the U.S. is 70%, approximately 70% chemical stocks. So it's very economically sensitive. You can see here that the sector itself has a strong seasonal period, by the way, starts in late January and continues into early May. And you can see here on an absolute basis, we've seen this consolidation box here. And we're at the bottom end of the consolidation box, which is actually a good place to be as you start this strong seasonal period for a sector. Now, overall, relative to the S&P 500, we've seen this upward trend taking place. And once again, we've come back down to the bottom of this line here, this trading channel. So we could see a bounce from here. We are oversold on a full stochastic oscillator basis, and we're just starting to turn higher on a relative strength index basis as well. So the sector has done well relative to the S&P 500. This is relative to the S&P 500, by the way. It has done well relative to the S&P 500 since September. Has pulled back recently on a relative basis, but it's still in that trading channel. It's just started a strong seasonal period. February tends to be one of the better months for the material sector, so we could actually see the sector actually perform quite well this particular month as well. Now, the energy sector, if we take a look at the energy sector here, look at the energy sector. Now, it tends to, as I said, it's started its seasonal period towards the end of February, but look at the strong absolute performance. This is using the ETF in the States, XLE, and this is relative to the S&P 500. Look at that rocket. But I do want to point out that we've seen this before. We see the strong outperformance, and then it comes down here. So it's not always a straight shot to the moon, and we could actually see a better opportunity perhaps later in the month. And a lot depends on some of the economic releases coming up shortly in February as well. So we could see some volatility, maybe a pullback. The seasonal period does start later in the month, and in fact, if we take a look at the seasonal period, and I'll come back to that in a minute here. Well, let's just jump right into that right now, actually. If we come back to that, take a look here at the energy sector here, you can see that I'm using the XOI index from 1984 to 2020 in this case. You can see here that February actually is not one of the better months. You know, it tends to be just around market, really, overall. It's really towards the end of the month you tend to find that pickup take place, and in this case, March and April. So the best 2 months of the year for the energy sector are still coming up. So a pullback here could present a good entry opportunity into that particular sector. And if we take a look at, let's just jump right back here. If we take a look at the technology sector, now, I didn't bring up the technology sector when I showed you the chart earlier. It can do okay in February as well, but I do want to point this out because a lot of investors do follow this. Here we did come back to that low level, really, once again, at the end of September, right? Same level on an absolute basis, and also too relative to the S&P 500, we came back to the same level. We've seen a little bit of a bounce from an oversold level, both on a relative strength and full stochastic oscillator basis. Now, the technology sector. What's going to drive the technology sector? If we see the economy starting to slow down a little bit and perhaps interest rates come back down, that would help to boost the technology sector. I know everybody's saying the Federal Reserve is going to raise rates, but yes, that's a federal funds rate, which affects the beginning part of the curve. Nevertheless, we could actually see interest rates come down at the same time as well. So it's good. A lot has to do with what's going to happen with the interest rates for the technology sector, I believe. If we take a look at the utility sector here, this is the utility sector I mentioned earlier on. Once again, it's been going up on an absolute basis. And look at this relative to the S&P 500. This is a defensive sector. And this has been while interest rates have been rising recently, it's still done okay. That's because investors are still a little bit concerned. They're not really buying into this rally yet. That may change, of course, but it has bounced from some oversold levels as well. If we take a look at the semiconductor sector, well, let's jump right back here. First of all, I want to go back to the book here and take a look at the semiconductor sector. And the reason why I want to do that is I've just got some selected subsectors here, and this tends to be one of the better performing sectors of the in this list here. From 1995 to 2021, it's outperformed the S&P 500 67% of the time. Silver tends to be close to the top here, although it only outperforms the S&P 500 50% of the time. So it's half and half. But when it does outperform, it can outperform quite well, and that's really the key here. And so if we see silver start to move, it can actually do quite well. Metals and mining is up on the list. Retail, this is actually one of the better months of the year for the retail sector. March and April, coming into April, tend to be strong for this sector here. Now, for the retail sector, you have to be careful because There's a huge retail inventory level that happened in December. I know there's a lot of supply constraints taking place right now, but perhaps the retail locations ordered a lot of product which would have actually shown up in the GDP numbers, etc., and some of the economic numbers. But nevertheless, it's coming in through the inventory side, and so there might be a huge inventory because the retailers were saying, "Well, if I can't get the product, I'm just going to order a whole bunch." So when all this comes off, I want to make sure I've got enough product. So we saw a large retail inventory level come out recently, which might actually have a little bit of an impact on the retail sector. The chemical sector, as I said, the material sector, the chemical sector makes up a large piece of the material sector as well. Gold, I'll talk a little bit about gold. It's about half the time, just under half the time, it outperforms the S&P 500 here. And, there's a lot of people looking at gold right now, coming into 2022. But and it tends not to be a huge month for gold, so we're tending to find that, especially later on in the month, it tends to pull back a little bit as well. Down at the bottom of the list, we find pharmaceutical companies, biotech tends to be at the bottom of the list. Home builders as well. Let me just show you pharma and, in this case, biotech here. And then home builders. Home builders is at the bottom of the list here on a negative performance, although half the time it tends to outperform the S&P 500. It's had a good run relative to the S&P 500 in its seasonal period, but the seasonal period ends at the beginning of February. So this is going to be really interest rate sensitive as well. So if we see interest rates go up, this sector, as it finishes a strong seasonal period, could actually underperform the S&P 500. Let's take a look at some of the subsectors I just talked about. And this is in this case here, this is let me just jump around here, sorry. Semiconductor sector. I'm using the ETF SMH. So it hasn't come back here. What we've done is we've really pulled back down fairly significantly in the month of January, and we've had a little bit of a bounce. And relative to the S&P 500 here, you can see that really we got back to the same level. So it's also, if we see technology pick up a little bit here, this might help the semiconductor sector and vice versa as well. So we're looking at the sector bouncing off from oversold positions like so many other sectors as well. Interest rates are going to be important depending on what's happening with the interest rates. If they're moving up, this could actually hurt the growth sectors such as the semiconductors and the technology sector. But it tends to be one of the top performing sectors overall. So in the month of February, so we could see a little bit of a bounce here, something to follow. If we take a look at I want to show you gold here as well. In this case, gold is really just being fairly flat. It's been this trading range taking place. And we did see relative to the S&P 500 that strong uptick. And that really was because investors were really concerned about the market and they were just looking for somewhere to go. And so they went into gold despite, at that time, higher interest rates happening and even a little bit of a stronger dollar. But now, as risk off is coming on and the dollar's gotten stronger, we've seen a little bit of a pullback for gold. So it tends to be mediocre here. We'll have to see if it can find some direction overall. If we take a look at, in this case here, the yield on the 10-year Treasury note. I want to talk about the yield on the 10-year Treasury note. In this case here, the yield is 1.78, and we saw this strong rise, and that's where the growth sectors really got hit as the yield rose sharply, and then we've seen this consolidation taking place. In that consolidation, we've started to see technology actually gain a little bit of a footing here. And if we see this actually, if the yield on the 10-year Treasury note starts to head lower again, that would actually be beneficial to the growth sectors of the market. Now, of course, it can head higher, and a lot of people are calling for that to take place, but we are in this consolidation phase right here. And the fact that the Federal Reserve is raising rates doesn't mean that this rate's going to go up. If we see weaker economic numbers come in, this rate can go down and put on a little bit of a surprise as well. Now, I wrote a newsletter back in January talking about the great rotation from growth to value, and I still think that's a key theme that could happen this year, but we might see a little bit of a reprieve from that in the month of February if we see interest rates head lower. Now, value tends to do really well on a seasonal basis starting in late February into March and into April. That tends to be a really strong period for value. So even though we might see technology in February actually do okay relative to the market, it may not be a long-lasting trend, and we may get back to that value trend in March, late February into March and April as well. If we take a look at another sector that I follow at this time of the year, and this is the small cap sector. Look at the small cap sector. This is the beginning of 2021. We're barely, not a very good line here, but we're just barely above where we started 2021. We're almost back to 2020. This is really incredible. We've been in this, we saw this trading channel take place here, this box, and it broke down. It broke up to the upside above it and came right back down. It broke to the downside and stayed below there so far. This is not a good sign. Relative to the S&P 500 here, I'm using the IWM ETF. We've seen this go down here. If we want strong true risk on, we want to see the small cap sector participate, particularly because it tends to do well at this time of the year. This is within a strong seasonal period, and it isn't working, which means that investors really aren't risk on. They really haven't bought into this. And just to show you here, we saw a strong move in the overall market back in the fall time, and that's when the small cap sector actually did quite well. It has become oversold. Like I said, so many of the other sectors of the market have as well. I want to look at another sector of the market here. This is Canadian banks. I'll talk a little bit about the seasonality as well. Canadian banks tend to do well from late January into mid-April at this point, but we've seen this strong run. And this is Canadian banks in this case, and this is relative to the TSX Composite. We saw that strong run. Now, what caused that strong run? Now, it's partly because interest rates were going up, but the Canadian banks are substantially different than the U.S. banks. The U.S. banks trade much more on net interest margins as one factor, as an example. So if interest rates rise and the market's going up, you'll find that the U.S. banks in general will strongly outperform the Canadian banks. Canadian banks are unique. It's an oligopoly, and investors tend to see them as safer investments. They pay high dividends. And so when the market's in turmoil, a lot of Canadian investors will go say, well, where do I go? And they will go into the banks. And that's exactly what we saw take place in the month of January. Now, we're just seeing this consolidation relative to the TSX now. If we see a strong risk-on movement in the month of February for the overall market, particularly if interest rates go down, we could start to see some weakness in the Canadian banks. Something to watch out for. We're still in a strong seasonal period, and they've done very well recently, but we could see them actually pull back. Now, if we see the markets really volatility pick up once again, really concerned about the markets, then perhaps you could see that actually the sectors do quite well. Now, in this case, you might find probably, maybe later towards the end of the month, in the second half of the month, the Canadian banks might start to pick up a bit, particularly as we get closer to the Federal Reserve making its next interest rate announcement on March the 16th as well. If we take a look at I want to take a look at other factors that are coming up here right now. And the first thing I want to talk about is earnings that are taking place right now. And if we take a look, this is for the S&P 500. This is from Refinitiv. Give them credit. This is from January 31st. Here's Q4 here. You can see that the earnings are in this case, the revenue 13.4% relative to a year-over-year basis, and the earnings 25.3% growth over last year. It's very difficult to tell, though, as far as these numbers, because we saw this really go down here quite a bit, and up it went, because these numbers here were going back as an example. This number compares to that. And so these base effects are really still having an impact on these numbers overall. And so we're seeing them come down like this. It doesn't mean that they're bad, but it's just on our comparison basis taking place. If we take a look at the actual surprises here in the market, you can see here this is on a revenue basis. So we're looking at the S&P revenue for Q4 once again. Surprises to the upside, 76%. That's fairly decent, actually. That's not bad overall. So you typically get a number above 50%. So just because it's above 50% on the surprises doesn't mean it's fantastic. There's a whole bunch of other factors. 76% is pretty good. If we take a look at what's happening from this level here, let me just move this over here a little bit. And on the earnings, 78.5% surprise to the upside on earnings. But there is something else that's happened. A lot of companies have actually been warning about operating margins being compressed in the future. And that's because of inflation. And that's the real key here. And as costs go up, they're saying that their operating margins look to be squeezed a little bit later on, and investors need to be wary of that. So we could see a little bit of softness later on. I think really what's driving, the big factor that's going to drive the market coming up, as we get closer to, in this case, March 16th. So I'm using the CME Fed Watch tool here. It's a great tool. If you want to type that into the browser bar, CME Fed Watch tool. You can find out all sorts of information about the expectations for future Federal Reserve hikes or decreases as well. In this case, for the March meeting, the futures market is predicting an 85% probability that the Federal Reserve will raise its federal funds rate by 25 basis points. And also, too, there's a 15% chance that it'll raise it 50 basis points overall. Now, so why is this important? It's important because when the Federal Reserve starts the tightening cycle, a lot of investors are going to wonder exactly what's happening to the markets. Is the Federal Reserve going to impact the markets? The liquidity has driven this market to the upside, and as we move closer to this date, where the Federal Reserve has sort of committed to raising rates, basically, starting its rate hike cycle. In fact, in this last meeting, it did what was called a hawkish hold. It held rates, but it warned on the hawkish side that about future tightening actions. So if you remember when I showed you that graph for February and said, look, it's the second half of the month that tends to be weaker. And if we do see that the investors start to become concerned later on in February about the Federal Reserve becoming more hawkish, then that's might be the time when we start to see investors start to pull back a little bit as well. Right now, we're a little bit far from that, and there are other economic announcements coming out, such as the non-farm payrolls and other stuff. But as we get closer to the Federal Reserve next meeting date, that's when we could start to see some volatility. So overall, February over the long term tends to be one of the weaker months of the year. But as I said, recently that hasn't been the case. We do start to see some of the cyclical sectors start to do well. I talked about the material sector. It tends to be one of the better performing sectors in the marketplace. And so you tend to find that some of the cyclical sectors can actually do quite well here in the market as well. And that usually will last until right through until May, early May. But the big driver is really going to be what's happening with interest rates. And investors are really focused on, the earnings have had an impact, and especially investors looking at the technology company earnings and saying, are they giving the support to the market, the bellwether companies in this market where most people look to. And so far, they've been helping at this point. But once we get past that, then we're going to start to see a little bit more concern. So February can be a volatile month. We'd like to see the small cap sector start to perform well, because usually on a seasonal basis, it tends to pick up in February, and so far that hasn't been the case at all. So it's really this mixed market where investors have been really concerned about really the economy and rising rates and the whole tightening cycle, and government's not stimulating the economy. And they're saying, well, where do we go? We've seen all this volatility between the sectors of the market. One day, one sector's up more than another, or the market's down, and we've seen some wild swings. And that really, sure, there's algorithms in the market, computer-driven programming, but it's also showing that the investors are really quite concerned about, which way the market can go at this point. And right now, I think it's prudent to be fairly cautious in this market. We may see a bit of a rally here because we saw that weakness in January, but I don't think that means that this market's going to continue strongly right now. We might see a little bit of a rally take place, and also perhaps a little bit of a pullback. I still think we can still do quite well overall in this 6-month window here and into March and April as well. So anyhow, it'll be an interesting month to watch, especially as we get closer to the end of the month and the Federal Reserve comes into view. Thank you very much for joining me today.